welcome to FinSight's Wealthier Way, brought to you by Finvesting. This is your go to podcast for decoding financial jargons, breaking down market movements, and simplifying wealth building strategies for everyday investors like you. Whether you are planning your first SIP, navigating market volatility, or dreaming of early retirement, we are here to guide you with actionable insights, minus the jargons. I am Narendran, your host and founder of Finvestin, and I believe financial wisdom should be accessible to everyone, not just the experts. So, plug in and power up your financial journey because wealth isn't just about how much you have, it's about how smartly you grow it. Quick reminder, play this episode at 1.5x for a better experience if you're short on time. If you have ever dreamed of becoming a crorepati but feel like your financial goals are slipping away under the weight of loans and daily expenses, this episode is especially for you. Today, we are diving deep into a powerful concept I call the 2025 rule, a strategic approach to asset allocation that can transform your financial future no matter where you are on your journey right now. I'm going to share practical strategies that have worked not just for financial experts but ordinary people like you and me. We will explore how to distribute your investments wisely, manage debt efficiently, and build wealth consistently over time. So, whether you are just starting your career or you are well established in your professional journey, these principles can help you create lasting financial freedom. Let's get started. Think back to when you were in your early 20s. Did you dream of becoming financially independent? Perhaps even a crorepati by your 30s or 40s? For many of us, that dream gets buried under an avalanche of financial obligations. Home loans that stretch for decades, car EMIs that eat into our monthly budget, personal loans for weddings or emergencies, and the list goes on. According to a 2023 report by TransUnion Civil, the average Indian between 25 to 45 years carries approximately 5.4 lakhs in personal debt. This is excluding the home loans. That's a significant burden that keeps many from investing for their future. As the legendary investor Warren Buffett once said, quote, "Do not save what is left after spending, but spend what is left after saving." Unquote. Yet, most of us do exactly the opposite. But here's the good news, it's never too late to course correct. And that's where our rule comes into play. The 25-25-25-25 investment allocation. Let's address one of the most common questions I receive. Where exactly should I invest my money? The investment landscape can be overwhelming with options like mutual funds, direct stocks, real estate, gold, PPF, NPS, and more. Should you spread your investments across all these categories or just concentrate on one or two? This is a big $1 million question. I am going to recommend a 25-25, 25-25 allocation strategy. It is just a starting point. Remember, this is just a framework to begin with. You will need to adjust based on your personal circumstances, which we will discuss shortly. Before we dive into allocation strategies, let's talk about a critical concept that is called your risk profile. Your risk profile is essentially your ability and willingness to absorb financial losses in pursuit of high returns. It is determined by several factors: your age and time horizon, your financial responsibilities, your income stability, your emotional comfort with the market's ups and downs, and your financial goals. All these put together form a concept called as risk profile, which falls typically three broad categories: one, conservative; two, moderate; and third one is aggressive. Conservative investors are who prioritize capital protection over growth and get anxious with markets ups and downs. Moderate investors tend to seek a balance between growth and stability. They are willing to accept some volatility for better returns. The aggressive investors, who are very much comfortable with significant short term volatility but in pursuit of maximum long term growth and returns. Understanding your risk appetite is essential because it should directly influence your asset allocation. Now, let's explore my recommended allocation strategy. The first one is 25% in direct equity shares. I might start directly with equity shares, but here's the catch: when you go along, you will understand. This portion of your portfolio is your high risk, high return component. Direct equity investments have historically outperformed most other asset classes over long periods. According to data, the Sensex has delivered an average annual return of approximately 14% over past 25 years. That's significantly higher than what most other investment avenues offer. However, equity investments comes with a high risk. They require a lot of time to research, need a lot of patience when markets are volatile during turbulent times like these, and long-term outlook. This allocation is ideal for goals that are at least 10 years away from the point of start. If you have a conservative risk profile, that is, if you have wealth preserving mindset, then you should consider reducing this allocation to 15% and focusing on established blue chip companies. Those with aggressive risk profile might increase this allocation to 30-35% and include more growth oriented stocks. The next one is 25% in mutual funds. Mutual funds offer professional management and diversification. They do the hard work required to pick the stocks and the time to invest in the stocks and the right value for the stocks. Basically, they do all the work what I have mentioned in the previous direct equity investment, and they give you, instead of the stock shares, they will give you in return of units. These are professionally managed and well diversified. For example, you can even consider more allocation within this mutual funds comes from large cap funds for stability, mid cap and small cap funds for growth, and debt funds for balance. A SEBI report shows that diversified equity mutual funds have delivered around 12 to 13% annually over a 10-year period, while reducing the risk through professional portfolio management. Again, your risk appetite matters here too. Conservative investors might shift the balance towards debt funds, while aggressive investors might allocate more to equity based funds or sectoral funds or even the small and mid cap funds. The third one is 25% in your tax saving options. This actually is kind of sounds like an outdated for right now with the tax implications and tax slabs changes. The category includes PPF, NPS, and ELSS. Now, ELSS might not be an attractive as there is no tax saving option in that. These investments serve a dual purpose. They help you save on taxes under Section 80C while building a safety net for your future. PPF currently offers around 7.1 interest, tax free with sovereign guarantee, making it one of the safest investment options available. While NPS, again, it has a different allocation within NPS as well. So, NPS, end of the day, gives you a better return than PPF, but there is no guaranteed return in that. Now, coming to the final one, 25% in real estate or gold. Traditionally, Indians have favored these tangible assets. While they may not always offer the highest returns, they provide portfolio diversification and act as a hedge against inflation. According to the RBI's House Price Index, residential properties in major Indian cities have appreciated at an average annual rate of 8 to 9% over the last decade. If maintaining physical assets seems challenging, you can consider alternatives like gold ETFs and REITs, real estate investment trusts, which is still in a very nascent stage in India that is not a very established one as we consider in other countries. As a renowned financial planner puts it, quote, the best investment strategy is the one you are able to stick to through thick and thin. Unquote. This model, which offers balance while leaving room for personalization and customizing your allocation. Now, asset allocation is not a set it and forget it strategy. It needs to align with your specific goals and timelines. Let's consider some examples. If you are planning to build a house in 5 years, allocate a portion specifically to buying a plot in your preferred location. This targeted approach ensures you are not scrambling for funds when the time comes. For medium term goals, like an international vacation in 2 to 3 years, consider investments in debt mutual funds or recurring deposits that align with your timeline. For long term retirement planning, equity heavy allocations make more sense due to the power of compounding over decades. Your risk appetite should also evolve throughout your life journey. Typically, younger investors can afford to be more aggressive since they have time to recover from market downturns. As you approach your financial goals or retirement, gradually shifting to more conservative allocation helps to protect your accumulated wealth. The founder of Vanguard Group, Jack Bogle, wisely said, quote, the idea that a bell rings to signal when to get into or out of the stock market is simply not credible. Time in the market, not timing the market, is what counts. This is particularly true when customizing your asset allocation. Focus on the time horizons rather than market timing. The debt free imperative. Now, let's address the elephant in the room, that is, debt. No investment strategy can succeed if you are drowning in a high interest loan. Financial freedom isn't just about building assets, it's equally about minimizing liabilities. Here's a sobering statistic. The average credit card in India charges between 38 to 42% interest annually. That's a financial black hole that no investment can compensate for. Here's my approach to managing loans effectively. Avoid unnecessary loans. Those tempting personal loan offers and top up loans from banks, they are often unnecessary financial traps. Before taking any loan, ask yourself, is this absolutely essential? Credit card discipline. Limit yourself to one or two credit cards for essential expenses. Use the 45-day interest free period strategically for genuine emergencies like medical bills or vehicle repairs. But remember, pay the full amount before the due date every single time. Follow the 20% rule. Your total debt payments should not exceed 20 to 25% of your annual income. For instance, if your annual income is 8 lakhs, Your loan payments should be below 1.6 lakhs per year or approximately 13 to 14,000 per month. Some loans like education or home loans is an beneficial in the long run because they increase your earning capability or it creates assets. But maintaining strict discipline is crucial. For a more comprehensive strategy on managing different types of debts, prioritizing payments, and negotiating better terms, I recommend listening to my dedicated episode titled Debt Management Breakthrough or Burden. That episode dives deeper into creating a structured debt reduction plan while maintaining your investment momentum. As financial advisor Suze Orman says, quote, debt is bondage. You will never, ever, ever have financial freedom if you have debt, unquote. While this may sound extreme, there is a profound truth in recognizing how debt can derail even the best investment plans. At last, it's a personal story. The 20% investment rule in my 20s, which helped me to get through tough times. I began my investment journey at 21, starting with just 500 rupees in a mutual fund SIP. It wasn't much, but it was a start. It was in the year of 2011. As my income grew, so did my investments. But I maintained one constant: I always saved 20 to 25% of my salary. Later, I opened a demat account to invest in direct equity shares. While these investments carried higher risk, they also offered potentially higher returns. Parallelly, I used to start reading more about all these investments and personal finance articles. It helped me to understand how it works and how I have to change my strategy and increase my returns. I'll just share my one of my best experience about picking a share, that is Balaji Amines. It's a chemical stock which I bought for 71 rupees in 2015. That same stock traded at an all-time high of around 5,000 over 4 years back. That's more than a 14 times return. However, I should note that I eventually exited this position after identifying certain red flags that did not exist when I first invested or during most of my holding period. This brings me to an important point about direct equity investments. Always conduct thorough research or consult a qualified advisor before investing. Never make investment decisions based on free stock tips from friends, family, peers, or random sources. Remember, if advice comes for free, it's likely just a casual hunch rather than a researched approach. Quality investment advice requires detailed analysis and should be valued accordingly. This consistent approach of investing 20% of my income taught me valuable lessons about conducting fundamental and technical analysis before investing, building a diversified portfolio aligned with my risk appetite, the incredible power of compounding, and putting it all together. Let's summarize the key principles of the rule. Start investing 20% of your income as early as possible. Allocate your investments across different asset classes according to your time horizon and risk acceptance level. For a more personalized approach tailored to your specific situation, you can always reach out to me with contact details in the description. Keep your debt under 20 to 25% of your annual income and avoid unnecessary loans. And customize your allocation based on your specific goals and timelines. Remember that wealth creation is a marathon, not a sprint. It requires patience, discipline, and consistency. The insights I have shared today come from my personal 14-year journey in financial management. They are battle tested principles that have helped me build wealth steadily over time, and they can work for you too. Financial freedom may seem like a distant dream when you are juggling EMIs, rent, and daily expenses. But with strategic planning and disciplined execution, it's absolutely achievable. Start where you are with what you have. Even small investments compound significantly over time. Prioritize becoming debt free while building assets simultaneously. Remember, the journey to financial freedom isn't about getting rich quick, it's about making consistent, informed decisions that align with your life goals. That brings us to the end of today's episode of Wealth Your Way by Finsights. We hope this information helps you move one step closer to defining and achieving your unique version of financial success. If today's episode got you thinking about your own rich life and how to achieve it, why not take the first step with Finvestin? Whether you are looking to optimize your savings, plan for your retirement, or make smarter investment decisions, we can help you create a personalized financial roadmap. Visit finvestin.com or drop a message on WhatsApp at 799 555 to schedule a free consultation. Let's turn your financial goals into a reality. Remember to subscribe to our Wealth Your Way episode on Spotify so you never miss our twice a weekly episode. If you found value in today's discussion, share it with someone who might benefit. This is your host, Naren, signing off. Until next time, remember that wealth isn't just about money, it's about creating the freedom to live your life on your own terms.